In this video, I would like to consider 10 disadvantages of money market funds. I want to explore these disadvantages and see precisely whether these investments could be the type suitable for you or not. Number one is low returns. Low returns. A money market fund generally provides lower returns than other asset classes like stocks, like bonds, and real estate, making them less attractive for those who are looking for long-term growth. The return is quite low, and for that reason, you may not be able to accumulate long-term growth in this investment vehicle. Number two is interest rate sensitivity. Interest rate sensitivity. Since money market funds invest in short-term instruments, their returns are closely linked to interest rates. So in a low interest rate environment, money market fund may yield, very low returns because their returns correlate with interest rates. So if the interest rate is kind of low, that would impact the returns of a typical money market fund. Number three is inflation risk. Inflation risk. The returns on money market funds might not outpace inflation, unfortunately. Meaning the purchasing power of your money can kind of decrease. Can decrease over time. Whenever inflation is high, you discover that the returns, the marginal liquidity return you get from this money market fund may not be able to outpace inflation, and so your buying power is kind of affected somehow. Number four is management fees. Management fees. Though the management fee here is sort of low, money market funds still charge management fees. It's not completely a zero fee investment. They still charge fees, which can reduce overall returns, especially in low interest rate environment. When you lose a certain amount of money in fees, then of course it will definitely affect the overall returns of your investments at the end of the day. So be mindful of fees when it comes to investing. Number five is no FDIC insurance. So unlike bank accounts, money market funds are not insured by the Federal Deposit Insurance Corporation. So that level of safety is somewhat lacking. So there's some level of risk, to your principal. Although they are generally considered safe, but for the fact that they're not insured, you could decode that, and it may not be as safe as it should be. Considering if the fund itself is insured. Number six is liquidity limitations. While money market funds are generally liquid, under extreme market conditions or financial crisis, access to your fund could be delayed, or the value of the fund could decrease temporarily. It is considered liquid, quite all right, but under certain conditions, it might not be as liquid as it should be. So in those circumstances, you discover that it might be difficult for you to very easily, access your money or to dispose your investments, or to sell off your investments. Number seven is credit risk. Money market funds invest in short-term debt instruments issued by companies and governments, which carries the risk that issuers may default in their obligation. When it comes to investing in money market funds, they do have bonds and other short-term instruments in their portfolio, and the issuers of these instruments may default, may go bankrupt, may have financial difficulties, and so may not be able to meets up with the obligations of settling, the holders of these of these securities, and that will really eat deep into the investment returns. That credit risk is always there. Number 8 is low growth potentials. Low growth potentials. Money market funds are designed for safety and liquidity. These are the principal considerations. Then, lastly, for capital appreciation. It is not for capital appreciation. It is designed for safety and for liquidity, and as well as regular income. So capital appreciation is it takes the back seat, which makes them unsuitable for investors seeking higher returns, or long-term growth. They don't provide, that desirable long-term growth or capital appreciation. They don't really provide that. Number 9 is regulatory changes. Changes in government regulations could actually affect how money markets funds operate, how they are taxed, potentially reducing attractiveness or effectiveness. So government regulations would then certainly affect money market funds one way or the other. Sometimes it may do it positively, and sometimes the impact will be negative in nature. So if it is negative, discover that it will affect the level of returns, the kind of returns you will have, through investing in money market funds. Number 10 is market risk. Market risk. Though money market funds invest in a relatively safe security, they invest in securities that are considered safe, relatively safe securities. They are not immune to overall market risk, and in times of financial instability, their values can fluctuate. Remember that, and these funds still invest within the markets. And if the markets, experiences a downturn, kind of financial instability, then the value of these funds will then fluctuate tremendously, and it might affect the returns you could get from these funds. And so these factors make money market funds less appealing for long-term investors looking for growth or higher returns. And so they are best used for short-term savings, or as a place to park your cash temporarily. So these are the advantages of money market funds. You could consider it critically, and if you are kind of contented and you want to go in for money market fund investments, I think that would be a very good investment choice.